Number one, ask anybody that's in Japan or in Europe or in Switzerland or in Denmark or in Sweden that have been using negative rates. You can go below zero, and that attacks your principal, because negative rates, if I loan you $1,000, you're paying me back $970. Wait a minute, I just loaned you that money.
Right.
So absolutely 100% we can go below zero.
Welcome to RTD. Today I'm excited to have my guest, Ms. Lynette Zang, the Chief Marketing Analyst for ITM Trading, a full-service precious metals firm. Lynette has over 30 plus years in stocks, bonds, as well as in precious metals. Today she's here to share her thoughts on the dollar as well as global currencies around the world. And so Lynette Zang, welcome to Rethinking the Dollar.
Very happy to be here, Michael. Thank you for having me.
My pleasure. Well, I'm excited to have you on. A lot of viewers have been requesting to have you on, so here we are. So I'm looking forward to getting your thoughts on the whole de-dollarization process, as well as the importance of precious metals now and head into this uncertain monetary time we're in. But before I dive into that, I'd like to start off with some RTD questions. And the first question is, what comes to mind when Lynette Zang hears the words rethinking the dollar?
Well, what comes to mind immediately is the reset of the dollar, and actually all fiat currencies, but a reset.
All right, fair enough. Now, a big part of the whole rethinking the dollar concept is basically to begin educating the younger generation, in particular, that have no real understanding of monetary policy, financial literacy whatsoever. So in your opinion, would you say that right now is probably one of the most important times in history for people of all ages to become more familiar with matters such as what we're going to cover now, and as well as what you cover?
100%. In fact, you gave me goosebumps. So yes, I do think that this is huge in history. Certainly, no, but and whether you're younger or older, I personally have found that most people don't really understand currencies at all, and they just use them as a tool of barter because that's the way we've been trained.
Right. Now you say the way we've been trained. So do you think it's been somewhat of a deliberate act by our school system as well as our government to make sure people don't understand things such as this? What are your thoughts on that?
Well, I would say that it starts with the government because the whole way that the fiat system is created, and remember, fiat is by decree, so that's the legalized government money, but inflation is baked into the system by design. And so they don't really want you to understand it, because if you understood how money was created and supported in this system, and the fact that by design it has inflation baked in, which guarantees that loss of value, then you'd say no. So I don't think the school systems understood it enough to make that change, but I'm certain that the central banks and the government certainly do.
Right, I do agree. Now that we are heading towards the middle of the year 2018, and so if Lynette Zang was given a chance to deliver what I typically call the global economy state address or something of that nature, where you were in front of a large audience and had to summarize where we're at now and where you see us going in the next days ahead, what would you tell the audience?
Holy crap. Okay, that'd probably be the first thing I'd say. But, there's a big LIBOR issue that's coming up by the end of 2021, where they have to modify any contracts that come due after that date, including big derivative bet contracts. And I don't frankly think that there's any way to pull that off with a great hitch. So we're in the end game by 2021. About 300 trillion or so in contracts must be amended,
Right.
or restructured. So there's your reset.
Right. Now you say coming down the home stretch, coming towards the end. So what does that mean? Does that mean like some type of ending because life will still go on, but what's coming to an end? What are you predicting? How will it play out, and what will it look like from those that may not understand what this monetary reset or whatever might be exactly?
Well, the whole entire system is built on constantly compounding, never-ending debt. And of course, with that, you have constantly compounding, never-ending interest. But that is how money is created and supported in this system. We are already, according to the Federal Reserve, okay, if it's true, we still have 4 cents left in value out of the currency.
Mm-hmm.
But the tool that they have to regulate the speed and the rate of inflation, which are interest rates, 90% of the industrialized world is anchored at zero. And so even though the Federal Reserve is attempting to raise rates, under normal circumstances into a financial crisis, they lower them about 5.5%, 5.75%. So even if they hit their stated goal, which is to 3.25%, this next crisis, and there will be a crisis, everything is severely overvalued, there will be a crisis. Mm-hmm. Interest rates will go below zero, and this is about attacking principle. They've already gotten all the value. Now it's about attacking principle. And what I really see coming is I see a war, and this is only because this is what always happens around currency resets. Mm-hmm. But, I see a war. I mean, we could be a little bit further along in that with the Iran deal if President Trump pulls out. Mm-hmm. So, and North Korea, and Turkey. There's a lot of areas. So I see a war. I see a lot of dissatisfaction, maybe even going into some kind of, revolution, because there's always protests that come up as well, and shifts. In 71, as example, mm-hmm. in 71, for those of your viewers that are old enough to remember it, I was certainly there as a teenager, I remember it. You had civil rights movement. Well, we still have a lot of work to do in that area. You had the women's live movement, and there's a lot of work that's being done in that area. You had the Vietnam War, you had the oil embargoes, you had a stock market crash, you had a bond market crash. So, and this kind of thing is quite typical around a currency life cycle shift. In 71, we went from at least a quasi-gold-backed currency. The gold was still there to create some kind of fiscal responsibility for governments. And then we shifted into a pure debt-based system, handing over full control to the banks who know what? Oh, I don't know, debt and leverage, yeah. Right? Yeah. And that system no longer functions. In fact, I can prove that it died in 2008. And it's just been a zombie system that's been kept on life support by massive amounts of money printing globally, just to cover everything up. But this next crisis, those balance sheets are too high. And we're looking at least 300 trillion in notional derivatives. And anytime anybody hears the term notional or nominal, immediately know, okay, I don't know what the value is at risk. Right. Nobody knows the true value at risk. That will be bailed in first. In other words, savers and anybody that's got wealth in the system, bye-bye. But you can't bail that out. Hence, the government, the central banks, the IMF, has been talking about the need of a global financial system reset. Well, yeah. So that's what I mean. We're really close to that. It will be very chaotic. It will be extraordinarily painful for most people. In the pre-conversation, we talked about your friends in Argentina. Mm-hmm. So, what that's like. We certainly know what's going on in Venezuela.
Yeah, good point.
They have no savings.
Now, let me ask you a question. Now, I asked a prior guest a while back in regards to because you hinted at the currency index and how we're operating on maybe 2-3% of the original value of the currency. So we have the purchasing power index, which is always, to my knowledge, ever since I've been rethinking the dollar, it's always been right above the zero line. And so a couple of guests say that it can never go below zero as far as its purchasing power. So one of the things I love to do is I actually go onto the streets and educate people. So I share this graph with them here, which gives them actual visual aid to see how much purchasing power has been lost over the last umpteen years. Now, in your opinion, can we go below zero? And is that hyperinflationary if it does go below zero? And what would that look like in a hyperinflationary type of environment?
Okay, that's a great question. Okay, so, and there's a couple questions in there.
Okay.
Number one, ask anybody that's in Japan or in Europe or in Switzerland or in Denmark or in Sweden that have been using negative rates. You then, you can go below zero, and that attacks your principal, because negative rates, if I loan you $1,000, you're paying me back $970. Wait a minute. I just loaned you that money.
Right.
So absolutely 100% we can go below zero. The beauty for what creates that restriction at the moment is cash. So for example, when Japan went to negative rates, they had a massive run on safes and lots of people hoarding cash. Because even though cash does not protect your purchasing power, and the Federal Reserve, Fred, is a great place to go to look at that purchasing power graph, and then you can scroll. And so I know even though it's looked like it's flat because you're looking at the longer term view, if you shorten that up, you're going to see it go just like this. Okay, so it is still going down. But so the answer is yes, and cryptocurrencies enable them to invisibly erode your principal because they're infinitely divisible. So it's just on a smaller scale. Now, what the whole world has been fighting, the central bankers have been fighting, is deflation. So negative rates would actually be deflationary, right? And we can look at the experiment that's been going on. Sweden was the first country to go negative rates in 2009. So you can see that they have not gone into hyperinflation, but rather they have been just doing their darndest to get those inflation rates up, when in reality, it's really the way they track inflation is ridiculous. But the only way, this is it, to fight deflation is with inflation. So where all the central banks have had a target of 2%, understand that that target of 2% is based upon you not screaming your head off. Okay? Because inflation is not really a monetary must. It is a fiat money must. It's baked into the system. So that's another big way that we know. But when stock markets implode, real estate markets implode, bond markets implode, like we saw in 2008, that's deflationary. And so what did they do? They came in and they've already generated the hyperinflation. When you see those monetary base numbers and the quantitative easing, the QE numbers on, bonds, government bonds, corporate bonds, mortgage-backed securities, all of these things, when this is going straight up like this, okay, that is hyperinflationary. It was simply absorbed by the bank and held in excess reserve, in this country anyway, held in excess reserves, and then funneled into the stock market that in the end of January made all-time highs, the most expensive stock market in the world. Right. And the bond markets, which hit lows about a year and a half ago, with the lowest interest rates, not in history, because zero, and during the Depression, we were there for a long period of time as well. But the bond market was the most expensive bond market in history, and real estate has, in many cases, has now surpassed where it was in 2006, which was the previous peak. Okay, so those instruments that we look at, that we depend on, that we've been trained to think, well, if the stock market's doing okay, everything must be fine because it reflects the economy. Yeah. Well, there's no good price discovery in anything, but those have been hyperinflated. So what, and actually look at your cost of living. I
Yeah.
mean, has it gone down since 2008?
Never.
Has it stayed the same?
Nope. Not at all.
Right?
Yeah.
So the cost of living has certainly escalated, and we can see that. Look at how much your insurance costs, look how much your, the education costs, your food costs, etc. Right?
Hmm.
So I would, even though nobody else is saying this, I would say that we're more sort of in a stagflation where you have what they're trying to keep inflated, the stock market, the bond market, the real estate market, which is really struggling. And especially, you had recently the Treasury, 10-year Treasury market, which is the foundation of the system,
Hmm.
hit 3%. Now, it needs to break through that 3% in a pervasive way, which it has not yet done, and pull back after that.
Hmm.
But that was a key critical move because it hasn't been that high since 2014.
Right.
So it could indicate, not yet though, but a loss of control. And you've got 80% of the derivative market that's based on interest rates.
All right. Now,
80% of 300 trillion that's reported after they do all this
yeah.
netting and compressing and,
Yeah.
financial engineering to make things look a whole lot better than they are.
Right. Now, let me ask you a question. You hinted at the whole idea of the indicator in the bond market or the interest rate reaching 3%. So is that one of the indicators? I hear a lot about people talking about indicators for what can be considered recession. So we are currently in or approaching a recession. What are some of your thoughts on the recession? Is that an indicator that typically leads to a recession? And how would you gauge and what do you use to measure whether or not we are in or never recover from the last recession? There's various viewpoints on that. What do you think?
There are lots of viewpoints on that. Personally, we never fixed the issues that happened in 2008. Officially, we've been out of recession since 2009.
Mm-hmm.
Okay, so I believe that we're still in a recession, and ask anybody that lost a middle income job paying in the six figures
Mm-hmm.
and is now struggling to get by in 50,000-60,000 a year, or have had to do part-time jobs, etc.
Right.
So it is actually accurate that typically, and again, you can find this easily in the Federal Reserve Fred website, where they've raised interest rates. And okay, what is the function of interest rates? So let's kind of back up here a minute.
Okay.
Okay. But interest rates are a key tool for central banks to regulate the rate and speed of inflation. So when they want more inflation, they lower rates down. That inspires people to borrow and spend. And when you start complaining about how fast inflation is going up, they raise interest rates up to to slow down
Yeah.
the borrowing and spending. Okay.
Mm-hmm.
Now, so in theory, because that's what it is, in theory, we must be in an overheated economy because the Federal Reserve is dead set on raising those interest rates. This is not 2006 anymore.
Right.
Okay. It's not. So, in that way, but they're still raising the rates, and that's to give them some firepower to lower them again during the next crisis,
Yep.
which is a joke.
Yep.
Okay.
Now, do you think they'll have enough room to actually get up high enough to drop it, or it has to go negative after that point because we're still at near zero? So how far negative can it go? Yeah.
Yeah, exactly. Historically, during every financial crisis, they have lowered interest rates 5.5% to 5.75%.
Mm-hmm.
You can see it on the Federal Reserve under Fed funds rate.
Right.
But there were a lot of other changes that took place in 2008, and one was for the first time ever paying banks to hold reserves. So their reserves went from this, because they would deploy that money elsewhere. We taxpayers funded it. It went straight up, and they're still holding a massive amount of reserves. And the interest rate is not on what the central banks would charge the banks,
Mm-hmm.
but rather what the central banks pay the banks to hold reserves. So every time they raise rates, what they're actually doing is giving the banks a raise. But there is a tipping point in that rate level where it then stifles borrowing and spending, and then you go back into another recession. But this is so much bigger than this.
Yeah.
So there's no purchasing power left.
Right.
And
So
there's no interest rate.
So with the unwinding aspect of them, the quantitative tightening or whatever it's called, so how are they going to unwind all of that they're actually paying to the banks to hold on reserve? How are they going to unwind that? How did that play out?
They can't.
They can't. Yeah.
They can't. It was an experiment to put it in, and now it's an experiment to think that you're taking it out. But keep in mind that you also have other countries like Japan and the EU and those other countries that are still in negative rates. Mm-hmm. Well, you know, they're talking about, especially in Japan, they're all staying the course. So the Federal Reserve is attempting to unwind this balance sheet, but the balance sheet that you're referring to, the unwind, is right now, and I'll have Megan send you the graphs that I'm referring to on these, so you can post those.
Yes.
But you know, the balance sheet that they are so far unwinding are the treasuries that are held by the Federal Reserve. Now, the interesting part about that is, you know, as long as there was enough other buyers or outside buyers of our government debt as the world reserve currency, you know, I mean, evolved nations never bought back their own debt. That's what third world countries did that did not have access or easy access to the capital markets. In reality, and according to the Federal Reserve, we started buying back our own debt the end of 2002. So people always think that nothing's happening until you have this massive explosion, when in reality, these things happen very, very quietly. They didn't want you to know about it. And it only became a good thing in 2009 when the Federal Reserve started buying massive, that's monetizing what the government spending is, but buying massive amounts of that debt. So they now are sitting on, you know, many trillions of those, and what they're doing to unwind the balance sheet is that they are no longer reinvesting all of the dividends and principal that comes back. So they said that it would be like watching ice melt, and it is. Okay, but you can see that too. You just have to go more narrow, and you can see where the unwind is. On the other part of the QE, which is mortgage-backed securities, which are actually derivatives in mortgages, well, in July, that started spiking on the longer term like crazy. So they may be marginally getting rid of it over here, but not over here, because between both of those areas, they were supporting something like 30% of the market. So who's going to come in to pick up that slack? Now, they have shifted the risk of bonds onto the retirement system in pension plans, etc. So much of who's picked up that slack is the area that can't really afford to pick up that slack, because that's going to kill the principal. That's when interest rates rise, principal values fall. When interest rates fall, principal values rise. So we had a 30-year bull market in treasuries as the interest rates were ratcheted lower so that it was easier to service the debt, right?
Yeah.
And, you know, how can they reverse it? They can't. They cannot reverse it.
So since they can't reverse it, that plays into the whole idea of de-dollarization, how our former creditors, China, Russia, China predominantly, but yet that Eastern Hemisphere, they're moving away from the dollar and doing their own bilateral trades and whatnot and currency agreements. So there's all these institutions that have been formed to basically get rid of dollars. So how do you see that playing out? Will that speed up, and will that activity lead to or be a trigger in this whole monetary reset or monetary structure and a crash before we get to that 2021 time frame? Can you see that being a reason why that could be a problem? So give me
Well,
your
I
thoughts.
think the answer is yes. I do see that as a problem. And, even though we think that this is a new thing, the de-dollarization is a new thing, in reality, it was 2005, and I think it was May. I want to say May of 2005 when Russia said you will no longer value any of our assets in terms of dollars. From here forward, our assets will be valued in terms of euros, rubles, and gold. Now, understand, and I'm sure this is something you talk about all the time, but I'm going to kind of back up to be a little more clear so I can fully answer your question.
Please do.
As the world reserve currency, what that meant was that if you were a government or corporation going outside of your borders to buy anything, lumber, steel, medicine, food, didn't matter what it was, soon as you went outside of your borders, you had no option but to use US dollars. So everybody had to hold a lot of those dollars and dollar denominated assets in reserve. But that really has been shifting. Well, in 2002, we no longer attracted enough buyers of our debt. In 2005, Russia said, you're not going to value any of our wealth. And they're a huge oil exporter, and they definitely have the market on platinum and a lot of other minerals. So, they've got a lot of resources there that have not been valued in terms of dollars since 2005. Now, since the crisis is when all of those bilateral and trilateral agreements have been reached that completely bypass the dollar. Okay, so the power has been shifting. Now, officially, we still hold that title, but and even though, foreign countries have been holding less and less of our dollar and dollar denominated assets, they still hold a substantial portion of them. So enter the IMF, the International Monetary Fund, which represents, well, there are 196 countries in the world, and 189 of them are members of the IMF. And that's every Treasury Secretary and every central bank chief. So that is really who is running this whole game, if you want to call it. And the IMF in '69 created a currency because we thought this was, or they thought, and actually we did too, thought that this was going to happen in '71 when we transitioned from the gold standard to the debt standard. So at that point, they created the SDR, which simply stands for special drawing rights. And honestly, it is a name, just like the dollar is just a name. But they know that people marry the legal money of the state. So they always keep the name the same, even when everything is changing. Okay. However, the SDR, I see him in front of my eyes. I'm sorry.
No problem.
Kissinger.
Yeah.
Sorry. When Kissinger went to Saudi Arabia and created the petrodollar, meaning that you had to buy oil in terms of dollars at that point, right? And then Saudi Arabia would then take any of their excesses and buy treasuries. Not sure who got the better deal on that, but it's quite clear that that deal is also breaking down. The Chinese yuan is now trading oil in terms of yuan. So yeah, this is an indication of our loss of status. We just keep the name. But the IMF created what's called the substitution fund. So if you're a government or a corporation and you're holding dollar denominated instruments, bonds, loans, things like that, you can deposit them into this substitution fund, and then the IMF will convert them into SDR denominated instruments. Now, the reason why they created that was to regulate the speed that those dollars come back to the US.
Hmm.
So we're really counting on absolute perfection in every single area. And the reality is these guys are not God.
Right.
They are humans.
Right.
And, if you look at their track record, they haven't been right most of the time, but they sure have been experimenting a lot with all of us.
Mm-hmm.
And I want that to stop. And that's what my work is about, is if you can understand what's happening when they take us into this next iteration, I want us to have choices. They don't.
Right.
They want us to lose. They're at a point where we are so conditioned to feel more comfortable in air, right? I
Mm-hmm.
mean, do you hold your wealth, or do you hold it in a stock market or a bank, or, you don't hold your wealth. That's called dematerialization. That's a whole nother topic that they have been hell-bent on creating since the 70s, and they've done a great job of it.
Right.
Really.
Right.
Oh my God, I got to store my gold. What a pain in the neck. I got news for you. If you don't hold it, you don't really own it legally.
Yeah.
That's the way this whole system has been set up. And people just assume, because nobody reads the fine print in those agreements or contracts or new account forms or mortgages or insurance contract or any of these things that are fiat money products that are designed to take your wealth away, but get you to volunteer it because you don't understand it.
Right. Here's another way of looking at it. Just recently, I came to the realization how I actually Googled this, and there's insurance offered for every single thing we would want to protect: housing, cars, life insurance, whatever. But there's never been anything implemented and proposed in the form of ensuring your purchasing power from your own government and the central banks. And so I came up with an idea of a national currency insurance policy, which is each individual person, owner, investor, saver, taking out their own personal private policy against their own national government in the form of precious metals. And so so that's something I'm going to begin talking more about, just because it's something different, and it's a way of getting people's attention, because everyone realizes they need insurance, but you never really realize you need insurance against your own government and the central bank. So let's talk a little bit about ITM trading and precious metals there. So one of the biggest things I've always had people ask me is, how much is enough? And so, of course, is dependent upon everyone's situation, but yet someone said, man, I always want more, I always want more. Based upon history from your research, what has been sufficient to prosper on the other side of a complete monetary meltdown, if that's a way of putting it?
Well, if you're like me, I've been studying currencies and currency life cycles since 1987. Okay. And also, I am a technician. I've also been a banker. So I've been a banker, a stockbroker. My uncle was a major dealer back east, so I learned about how these things move. And I believe quite firmly that everybody needs to understand three key things. Number one, what is the fundamental value, or how much in terms of that currency is something really worth? Because that's the only way that you can determine whether something is undervalued, fairly valued, or overvalued. Therefore, do I want to buy it? Do I want to hold it? Do I want to liquidate it? And actually, I'm going to be talking about that in the part 4 of a series on hyperinflation that I'm doing. So I'll be talking about that shortly. I also believe that people need to have a basic understanding of what the true trend is, and whether or not that is positive or negative. So what we see is the value of the dollar going down like that. But what people look at is the stock market and the bond market and the real estate market going up like that. Well, if everything you hold is denominated in dollars, meaning you can only convert them back into dollars, then this is the real trend. You're just being diverted to look over here. Look over here. Don't look at what's happening here. But if everything you have is look, in Zimbabwe, you've got quadrillionaires that are starving.
Yeah.
right? So it doesn't matter how many pieces of paper you have or how many digits you have. It matters what you can convert them into. So I think that everybody really needs to be clear on the trend. And then finally, I think everybody needs to be clear on where we are in this trend cycle, because every trend has a pattern that you can see, even into currency life cycles, which look real similar to, the life cycles of a human being. My granddaughter is 3, my grandson's almost 5. I guarantee you they're at a different life cycle than I am at 63. So, currencies are absolutely no different. And once you understand what that pattern looks like, it's actually easy to see. So, having said all of that, I firmly believe that you really should have most of your wealth in an undervalued or fairly valued asset that is in a long-term positive trend, and the least amount of your wealth in an overvalued instrument that is in a long-term negative trend. So that goes back to everybody must do what they're comfortable with. But personally, as a technician, as a historian, as an ex-banker, as an ex-stockbroker, I do not own any stocks, any bonds, any of those products. I don't own them. I have dollars because that's still our tool of barter, but I have enough in the system to keep my accounts open. I don't keep more than that in there. I can always make a deposit. Right? But you may not, as we've seen in Cyprus and Greece and Portugal and Ireland and lots of other places. You can't necessarily, and even in this country, you can't always make a withdrawal.
Right.
So, that's me. That's because I know the level of research that I do. I've been jumping in this rabbit hole for a very, very long time. I see it clearly. For many people, if they do not have that level of comfort, then we do know what the true value of an ounce of gold is if they were going to do the reset today, and it's well over $9,000. Silver is well over $600. That's its true value, not its manipulated value that Wall Street wants you to believe. So it's a bargain. That's how you protect your wealth. You're buying low. You let that whole system implode. And that's how they do a reset, is revaluing the currency against gold. Venezuela in February did their official reset, and gold went up over 2,600 times, not percent, times overnight. Okay?
Yeah.
So that's how it's done. It's real simple. So at the minimum, whatever you're going to choose to keep in the system, you need to have enough gold to balance that out. So if this goes to 0, you're okay over here. So that's really what we do here. I developed a strategy that's based upon the normal life cycle of currencies, and I've done studies on how all asset classes work. I just did a YouTube video on that last week, so that you can see that trend piece and where we are in the trend piece. But we've developed a strategy that's based upon my studies of repeatable patterns. And we like to work with individuals so that we can support their goals, because your strategy would be tweaked to who you are, what your circumstances are, what you have to work with, and what your goals are. Right. And they could be a little different than mine. But basically, you and I would be executing exactly the same strategy. Right. And that's what we do here.
Fair enough. Well, Lynette Zang, I appreciate you for joining me on Rethinking the Dollar. I know I've learned a lot myself from listening to you, and I love following your work. And so before I let you go, how can the audience be a blessing to you? Can you share with us what makes ITM trading different than all the other precious metals companies out there? And then we'll sign off and hopefully have you back on in the future, because I love talking to you and love learning from you. So share with us how people can be a blessing to you, as well as learn more about your company.
Well, people can be a blessing if they share the information that I provide, because we have to develop community. My mantra is food, water, energy security, barterability, and wealth preservation and community. So as far as being a blessing, share so people know. What makes us different is that strategy, because while we actually do work with the physical metals, both gold and silver, any of the precious metals, but gold and silver are the two monetary metals, so that's our focus. We have a system that is designed to make sure that you can support your goals through this reset. And that's what makes us different than anybody else, is that strategy just based upon normal historic patterns and how that wealth shifts. But we are physical precious metals. So they can go to our YouTube channel, which is just ITM Trading YouTube, and we publish new reports. I do research reports every week, so we publish that weekly. We do a Q&A, but our YouTube channel and of course our website, itmtrading.com. We love questions. We love, I've got a great team back here of precious metals consultants. We've all been here for, pretty much all of us have been here for a very, very long time, and we all pay attention. And we are absolutely a team here. So I think that's also what makes us different.
Okay, fair enough. Well, Lynette Zang, thank you once again for joining me on Rethinking the Dollar. Look forward to continue to follow your work and continue to just learn as much as I can from you as well as other people in the sector.
Oh, it's my pleasure.
Thank you for all you do.
You.
Look forward to communicating with you again. Thanks for joining me.
I look forward to it too.